We are going to discuss about the various techniques of financial statement analysis. So financial statement analysis is a procedure in which we are going to break up the components of financial statements into different component parts. For example, all current assets are classified on the basis of their nature. Nature of current assets are those assets that get converted into cash within a period of 1 year. Then again we classify various items, and today if you look at your vertical balance sheet, already you have the items in the balance sheet which are classified on the basis of their inherent nature. So the techniques of financial statement analysis implies the classification, the categorization and the comparison of various financial items or items that we find in the financial statements into different component parts, putting them into certain specific groups which will enable us to compare them one with another. So the first and the most simple technique of financial statement analysis is the comparative financial statement analysis, or the preparation of comparative financial statements. Comparative financial statements means financial statements of more than one period, that is year 1 and year 2 are taken together, and then the change that has taken place, the increase or the decrease that has taken place in the individual items of the balance sheet separately or statement of profit and loss are considered, and the percentage of increase and decrease is calculated. I repeat, in the case of comparative financial statement, two financial statement details are taken and details of 1 year are put side by side with the second year. When compared to the first year, in what way have the items changed? Have they increased? Have they decreased? Or are they the same? This information is measured and then the percentage change is calculated. The same thing is done in the case of a comparative profit and loss account. Okay? Second one is common size financial statements. Common size financial statements are the preparation of 2 years or even 3 years can be done, and this is a form of analysis which again is vertical in nature. When you look at comparative financial statements, we compare 1 year with another year, which is called as horizontal analysis. But if we compare 1 year's figures with the same year's figures, we call that vertical analysis. Under this common size financial statement, if we are preparing the common size balance sheet, the total of the balance sheet liability side is taken as the common size to measure all the items in the balance sheet. For example, we see that if the total of the balance sheet is 500 crores and if the share capital constitutes 100 crores, then 100 divided by 500 into 100. So that is equal to 20%. So balance sheet share capital constitutes 20% of the total. So common size refers to the common measure. So you take 1 year's balance sheet, only 1 year's balance sheet. Vertically you consider the various items in the balance sheet and measure each item in the balance sheet with the total of the balance sheet. So the common size, the common measure for a balance sheet, common size balance sheet is the total. Now coming to the profit and loss account. In the statement of profit and loss account, the revenue from operations or sales, or we commonly know it as sales. This revenue from operations is considered as the common size. The common size. taking into account each of the other items and measuring that as a percentage of revenue from operations. For example, if we have other expenses as 20 crore and revenue from operations is 120 crore, then other expenses will be measured as 20 by 120 into 100. This will give you the percentage of other expenses vis-a-vis the revenue from operations. This is how we prepare common size financial statements. These are basically very easy methods of financial analysis. The third one, all these are student favorite methods. Trend analysis. Trend analysis is a horizontal method of analysis. Horizontal means we compare different years' balance sheets. Vertical means we compare only 1 year's balance sheet. That is analysis. So trend analysis refers to the technique of measuring various changes that have taken place in the financial statements by taking the earliest year as the base year. So you have 1 year as the base year, and then you have year 1 after the base year, year 2 after the base year. So if the sales or revenue from operations in the base year is 500 crore, in the first year it is 600 crore, first year after the base year, and in the second year it is 650 crore. If these are the details, how do we measure the trend? What is the trend? Now, trend percentages are measured as, in year 1, take 600 divided by 500 into 100. Can anyone tell me the answer? 600 divided by 500 into 100. 120. So 120 is called as the trend percentage. Again, 650 divided by 500 into 100. 130. 130, right? Yes. So you see here that the base year's percentage is 100. This is considered as 100. The base year's figures are considered as 100. And the items of the years after the base year is considered as a percentage on that 100. Right? So you can calculate for any number of years after this. So the same procedure is followed whether you do balance sheet or you do statement of profit and loss. It's one of the very, very simple techniques of financial statement analysis. So we have just seen 3 methods which are the most basic methods of financial statement analysis. Now we go to the more advanced techniques. We have ratio analysis, and we have cash flow analysis. Now these two are sophisticated and mandatory systems of analysis which most companies have to do and even display it in their financial statement, in their reporting. Okay? So briefly I'll explain what ratio analysis is. It requires a whole different lecture. Ratio analysis refers to the use of mathematical ratios to show relationship between different items in the financial statements. I repeat, ratio analysis refers to the technique of using mathematical relationships, okay, as a basis to define relationships between different items in the balance sheet. Okay, so with the help of ratios, there are 4 groups of ratios. Short-term solvency ratio, which we call as liquidity ratios. 2 long-term solvency ratios, called as capital structure or leverage ratio. 3rd, activity ratios or turnover ratios. And 4th, profitability ratios. So there are 4 major groups of ratios which we will be covering in the further lectures. And the 5th one is cash flow analysis. Cash flow analysis, as per the accounting standards, 3 is mandatory and it has to be part of financial statements. Cash flow statement measures the changes that have taken place in the cash in two different balance sheets of two different years. So this refers to the classification of cash flows as cash flow from operating activity, cash flow from investment activity, and cash flow from financing activity. So this is a very sophisticated and a modern method of recording cash flow changes that have taken place. Okay, so we will go into this in detail from now onwards.